Richard Koo, it is a pleasure to talk to you. I'm looking at your book right now, The Holy Grail of Macroeconomics, which I had read during the Great Financial Crisis. So I'm really excited to talk to you about your ideas about the balance sheet recession in particular. I want to talk about right now, but actually I want to frame the issue and go all the way back to Japan because that's where it all began for me. I noticed that Adam Posen, he had called Japan's lost decades what he called the Great Recession. And I've seen that you said that that was a really apt way of looking at it. Well, what can we actually learn about the Great Depression based upon what happened in the Great Recession in Japan, given all of the data that we have that we didn't have during the Great Depression?
Well, I was in Japan at that time, 1990 onwards. I was there from 1984. And I was a believer in the usual explanation of Great Depression because that's what we were indoctrinated during our college, graduate school days in economics department. Then I observed Japan where interest rates came down to zero, Bank of Japan pumping tons of money into the system and nothing happening. And so we were all puzzled by it. And one day I looked at corporate borrowings of Japanese companies and realized that they were actually paying down debt at zero interest rates. And that forced me to think that how would company pay down debt at zero interest rates? There has to be some sort of a financial problem or balance sheet problem. And then I looked back and put all these ideas together with the data. Japanese companies during the bubble days borrowed tons of money. Bubble burst, asset prices collapsed, liabilities remained. So they all had to repair their balance sheets by paying down debt. And paying down debt is the right thing to do for companies with plenty of cash flow, but balance sheets underwater. Japanese companies at the time still had excellent products, exports massive surplus because consumers all around the world wanted to buy Japanese products. So there's nothing wrong on the production side, the supply side. Only the balance sheet was underwater. So everybody was using cash flow from their products, main line of work, to repair the balance sheets. That's the right thing to do. But in a national economy, if everybody is in the national economy, if someone is saving money, someone else has to be borrowing money to keep the economy going.
Right.
And in the usual economy, interest rates would adjust to make sure that savings and investments are more or less in balance. But when everybody's repairing balance sheets after the bursting of the bubble, even if you bring rates down to zero, nothing happens because there are no borrowers. And once I understood that part, that everybody's doing the right things, nobody's doing the wrong things, but then you end up with this recession because of the fallacy of composition problems. Then you look at Great Depression, you see exactly the same pattern, that after the stock market crash, October 1929, everybody started paying down debt all at the same time, but the government did not come in to borrow. So the economy collapsed. GDP disappeared to the tune of 46%. Nominal GDP fell by 46%. Unemployment rate going sky high. Then you compare that with Japan. Japanese bubble was even bigger than the Great Depression, 1929 bubble. But Japanese GDP never fell below the peak of the bubble, even though private sector sorts are paying down debt like crazy. And that was because the government came in and borrowed the money. So that's how I came up with this whole concept of balance sheet recession, and then applied it to Great Depression. And I was, I think, able to explain how Great Depression actually happened. The key difference between the balance sheet recession world that we were in until 3 months ago and the world we are in now is that the financial market is much, much tighter, much more difficult to get money. And the reason is that the world that we lived until 3 months ago, private sectors in all the major economies were in financial surplus, meaning they were saving money. Private sector as a whole, meaning household sector, corporate sector, and financial sector taken together. They were all saving money in US, Europe, and elsewhere, even with zero or negative interest rates. So they were not back to the textbook world at all. In the textbook world, they would be borrowing money at zero interest rates, not saving money.
Right. And do you see any analogs to the Great Depression there? I mean, because the sense that I got is the Mellon Andrew Mellon, his view was actually, you know what, we're going to let these companies go under because they're poorly run. And ultimately, that ended up having sort of a vicious cycle because someone else's income is someone else's output. So when this output goes away, someone else's income goes away. The whole thing starts to fall apart.
Right. There were, of course, people who, went overboard during the bubble days.
Right.
And it's unfortunate that actually happened. But when people are repairing balance sheets, they are all doing the right thing. If you're in that situation, I'm sure you'll be doing it. If I'm in that situation, I'll be doing it. If I have income, I use that income to pay down debt so that I reduce my liabilities to where the value of the asset is. And that's how you repair your balance sheets, right? You compress your liabilities until it's balanced with your assets. But if everybody's doing the right thing, you could still get a wrong result. And that's the problem with the balance sheet recession. It's not someone that is doing something really bad. Then we can go after those bad guys and shoot them down. But in the balance sheet recession, everybody's doing the right thing. I'm doing the right thing, repairing balance sheets, trying to be responsible. You're doing the right thing, trying to be responsible and fix your financial house in order. But when all of us do it all at the same time, then the economy collapses.
Right.
And in that situation, you don't ask who is doing what. The majority of the people, at least, are doing the right things, which is why we get the wrong result. But individually, they cannot do anything different. I cannot say, I'm not going to repair my balance sheet. This guy will go bankrupt, which is even a worse situation than you started out with. And so the government has to come in and take this extra money and put that back into the income stream. During the Great Depression, during the Great Recession in Japan or in the United States and Europe after 2008, the money should be spent on something like public works because that really goes into the economy. And workers get the money, they spend it, and the economy moves forward. However, in this recession, the pandemic recession, the government should really not spend the money, but put the money into the hands of the people who need them because they really need the money right away. I mean, if we try to come up with a nice bridge and highways, someone has to, produce the drawings, you have to go through the auction process or whatever. By then, everybody will be dead. So in this recession, we don't want government to be spending money on public works. I mean, if they have extra money, of course, they can do that. But they should be spending money directly into the hands of people so that they can make the ends meet until someone comes up with a vaccine. So it's a kind of a short-term battle, maybe year and a half max. But during that time, you don't want those companies to go under. And so even the use of money would be very different compared to the balance sheet recession situation.
Well, that makes me think about three different time frames. There's the time frame during the lockdown that we're in now in the U.S. that we're just coming out of. There's the time frame after the lockdown, and then there's a time frame after the vaccine is found. So you were talking about the collective time frame between when the virus hit and when the vaccine's found. One thought I had is about whether you can bifurcate those two in terms of timing, because right now it sounds like we're filling a hole that was left because outputs just dropped through the floor because no one's working. But once we start up, you're not necessarily going to be filling a hole. You are going to want to jumpstart the economy. And if you don't jumpstart the economy, then you're going to get this so-called L-shaped recovery. What do you think about the difference between how government directs their money before the lockdown and how they direct their money after the lockdown?
During the lockdown, of course, the money has to go to the people who need them desperately.
Right.
Then I think we will have a period where we don't know when the vaccines will be found, but suppose the medical problem is behind us. Mm-hmm. Then the economy should be recovering. And that recovery probably will be very rapid because of the pent-up demand. People are not locked in the houses for so long. Now they want to come out and spend some money. So that recovery will be pretty fast.
Right.
And that part probably won't require too much government intervention. But the next step is where I worry, and that is that once the income returns to a normal level, ordinary level, what would people do, or what lesson did people learn from this pandemic? I think the key lesson that these people have learned from the pandemic, would have learned from the pandemic, would be that, oh my gosh, we really have to have savings for the rainy days.
Right, definitely.
And they have exhausted their savings during the lockdown and period before and after. So my guess is that once economic recovery reaches a certain point, people will be rebuilding their savings again, or resaving, as it were, because they lost so much savings during these couple months. And furthermore, all these medical experts are saying we could have second wave, we could have third wave, and they remember what it was like in the first wave. You were really scraping the bottom to make the ends meet. Oh my gosh, we need to have a good savings. If they all start saving money, this would be just like balance sheet recession again.
Right.
And in that period, government might still have to pump in money to do public works and whatever, if that urge to resave turned out to be very large. We don't know that yet because we haven't got there. But if the people really decide to resave after the initial recovery, then we might end up having a private sector, just like the private sector we had during the balance sheet recession, where they are the net savers. But that also means, if that happens, that also means inflation is not going to be a problem for a long time.
Right.
People are worried that central bank, the Federal Reserve, Bank of England, ECB, Bank of Japan, pumping this huge amount of money into the system right now, and we got inflation could be just around the corner. But if the private sector then becomes net savers again after some period, then inflation cannot really go on. And that will give plenty of time for the central bank to unwind the monetary policy that they expanded so rapidly during the pandemic. And so, yes, we will have a recovery once the medical problems behind us, but then we might enter something like the world we had 3 months ago again, but for a different set of reasons.
Right.
That one was deleveraging. This time is rebuilding savings.
But, it's interesting that you would say last time it was deleveraging, this time it's for building savings. I almost feel as if it's as if we're back to square one, so that it's deleveraging and building savings at the same time. And it reminds me of, going back to what you were saying about Europe and the U.S., where the Europeans and the U.S. were after the great financial crisis. Even, 10 years after the great financial crisis, there was a sense in which we were still in a balance sheet recession. You said all of the private sector was in surplus, even though interest rates were at 0%. So that tells you that. So looking west at the Europe and the U.S. and the most recent financial crisis, what did the bursting of the U.S. subprime bubble and the attendant great financial crisis do regarding validating your balance sheet recession framework?
Book that you mentioned, the Holy Grail Macroeconomics, came out March of 2008.
Right.
And I will say U.S. is going through the same process that Japan just went through. And I think the prediction came true. Federal Reserve brought rates down to zero very quickly, because remember at that time there was an argument that BOJ was too slow.
Right.
So if you bring the rates down quickly, things will be so much better. Well, the Federal Reserve moved it down very quickly. Still nothing happened. Then Bernankes started the QE, increased monetary base by massive amounts. But money supply growth, credit growth remained very low credit growth actually went into negative range, just like during the Great Depression. During the Great Depression, the credit growth was actually negative all the way until 1936, from 1929, 7 years, even though monetary base was increasing very rapidly after 1933. And if you just look at the monetary base, you think, U.S. economy recovered because of the Federal Reserve changing monetary policy to a much more expansionary one. But when you look at the credit growth, how much money actually came out of the banking system and entered the real economy, it was still negative from 1933 to 1936. And it recovers very, very slowly from 1936 all the way until the World War II. So the only reason money supply grew after 1933 was government borrowing money, which was President Roosevelt's New Deal policies. And when you actually look at the chart that I have in the book, I'm sure you have a chance to look at it, money supply is a liability of the banking system because it's basically bank deposits. For liability to grow, the assets must grow. And you look at what assets grew in the bank's balance sheets. It was lending to the government. And so it was the government borrowing, starting in 1933, that increased both the money supply and the GDP, because the private sector borrowing remained flat all the way until early 1940s. Same thing happened in Japan after 1990, and same thing happened in the United States and Europe after 2008. Private sector borrowing was collapsing, even though monetary base was rising very rapidly because quantitative easing. But because this money could not come out of the banking system because private sector was not borrowing money, inflation remained flat. So I think Great Depression was a balance sheet recession. And I would say Great Depression was a balance sheet recession in the purest form, because the government did not enter during the first 4 years, from 1929 to 1933.
The question that a lot of people seem to have in that situation is what I would call the fairness doctrine. That is that, it depends who's getting the money, and is that a good thing? So the question is, are the big companies getting the money? Are the small companies getting the money? Are well-run companies getting the money, or are poorly run companies getting the money? And a lot of people have the conclusion that when it's an exigent circumstance like this, and you're flooding the system with liquidity, a lot of companies that are poorly run, that have low productivity, or that are just simply large, are getting money that they don't deserve. What do you think of that whole criticism of how this is being done?
Well, if we somehow have a perfect knowledge, and in advance that some companies are lousy and some companies are good, then of course, by all means, let the bad companies go and continue keeping the good companies. But we don't have that kind of perfect knowledge. But the time is of the essence, right? If you don't do something now, and this virus really decimates the population, we're really in sad shape. And so when we are in a situation like this, I would say that save everybody. Don't ask too many questions, because if you keep on asking questions, the other side will say, well, it's too much trouble to get this money from the government. Too many paperwork is necessary. I'll just give up. And that hurts everybody. And furthermore, all these criticisms about fairness, that they say the rich shouldn't benefit, but rich is always a minority. Rich people are always minority in any society, right? In order to make sure that the rich doesn't benefit and the poor people get hurt, that's completely against what you're trying to achieve. It's even if some rich people get this extra money, we can tax them later. But to make sure that the money who is needed should go to the poor people as quickly as possible. And because the speed is so important in this thing, I think we should put this fairness issue aside, save everybody. And if the rich had extra money, well, we can tax them later. I think that's the way we should approach this issue.
One thing that I was thinking as you were saying that, I was thinking about the term that Ludwig von Mises has used called malinvestment. Because a lot of people, especially from the libertarian perspective, they say to themselves, wait a minute, if we allow the government to deficit spend at these levels to make up for the private sector savings, then the government might actually use the money to build bridges to nowhere. And ultimately, it's going to be a negative because productivity-wise, those aren't very positive. They're not net NPV type of projects. What's your thinking about dealing with that malinvestment question?
The assumption that these authors are making is that if the government won't spend the money, the private sector will. And if the private sector will borrow and spend the money, then of course, private sector on average are far better in spending money than the public sector. So your malinvestment argument holds in that case.
Right.
But suppose if the government doesn't borrow the money and spend it, and the private sector also doesn't borrow money and spend it, then what is the outcome? It's far worse than even with malinvestments, because the economy will be collapsing in a deflationary spiral. So if I may give you a numerical example, if I have $1,000 of income myself and I spend $900 myself, the $900 is already someone else's income, so that's not a problem. The $100 I decide to save will go through the banking system, financial market, give it to someone who can use it. If that person borrows and spends it, then the total spending is $900 that I spend, $100 that this guy spent, together $1,000 against the original income of $1,000. The economy moves forward, right?
Right.
That's the usual world. And in the usual world, if the borrowers, there are too many borrowers or too few borrowers, interest rates usually adjust. If there are too many borrowers, they'll be bidding for the funds, rates go up, and some of the borrowers drop out. If there are too few borrowers, rates come down, and those people who were on the sidelines might come up and decide to borrow money, and that's how economy moves forward. That's the usual textbook world.
Right.
But in the world that I call balance sheet recession, which usually happens after bursting of the bubble, you bring rates down to zero, and the people are still repairing balance sheets. And so I have $1,000 of income. I spend $900 myself. But the $100 that I saved gets stuck in the financial sector, even at zero interest rates, because no one's borrowing money. So the economy shrinks from 1,000 to 900. And then the 900 is someone else's income. I get the 900. I decide to save 10%. So I spend 810, decide to save $90. The $90 gets stuck in the banking system again because people are repairing balance sheets. Then the economy goes from 1,900, 810, 730 very, very quickly, which is how U.S. lost 46% of its GDP from 1929 to 1933. Now, this is far worse than any idea of malinvestments, because to come out of that depression with GDP down 46% is going to take huge amount of effort. And it's sad to say that it really required Japanese attack on Pearl Harbor to get this thing back up again.
Right.
Because then the government spent massive amounts building battleships, aircraft carriers, tanks, fighter planes. And that's how U.S. was able to come out. Now, talking about malinvestments, which one is that better, right? I would rather have the government spend the money from 1929 to 1933 to keep the GDP going, allow private sector to have income to pay down debt, repair their balance sheets, and then government removing themselves, allow the private sector to take over. And that's basically what happened in Japan. Japanese government came in quite early in the process, start borrowing and spending money. That's why Japanese GDP never fell below the peak of the bubble, whereas US allowed GDP to fall 46%. Unfortunately, at that time, at the very beginning, no one understood this mechanism of balance sheet recession. And I didn't understand it either. So every time the government put in the fiscal stimulus, the economy, of course, responded because government bought $100 and spent it. But they say, so it's back to 1,000. Everything is fine. So they cut the deficit again, but people still repairing balance sheets.
Right.
The economy collapsed. So we had this zigzag, which was very, very unfortunate. If we had known in advance that this is this type of recession that takes about 5, maybe 10 years for private sector to repair balance sheets, if they had that knowledge in advance, they could have planned their projects much better, right? Because we're going to be in for 10 years. Hey, let's come up with a good project. But at the beginning, they thought, 1 or 2 years of what Larry Summers called, what was the term?
What did he call it? He calls it secular stagnation.
No. He said big jolt. Initial jolt of a fiscal stimulus, then it's a pump priming and the economy will be back.
Right.
That's how Japanese were thinking back in 1990s. A big jolt, yes, we did it. Economy recovered, so they removed it and then went down again. Another jolt, and it went like this, which was very, very unfortunate. If we had known in advance that this is going to take 5 years, maybe 10 years, then they could have planned better investment projects, and this Mao investment argument would not have hit the media as much as it did.
Well, let me ask you this, because this is something that's related to what you were talking about the outcome today, inflation. As you were saying that, the first thing that came to my mind is, how do you know that you've dealt with the problem enough? And my answer was inflation, meaning that you won't get inflation, you were saying, in our economy for a very long time until these balance sheets are repaired. What are the signals that you would be looking for to know that the balance sheet recession has been solved?
Well, I would be looking at private sector borrowing numbers, both from the capital market and the banking system, to see whether the private sector is really coming back to borrow money. And if that happens, of course, interest rates will be rising, and that will be the signal that I'll be following. So if we see interest rates rising, and if I were the central banker, I will call up bankers to see, is this something on the supply side or on the demand side? I mean, interest rates can go up for a number of reasons, so you want to make sure that it's going up for the right set of reasons. If it's a supply of funds problem, the central bank can ease monetary policy and the rates can go down again. But if it's a demand problem, that borrowers are really coming back to borrow, then it's a sign that, hey, balance sheet recession is already over. We're back to the textbook world. And in the textbook world, central bank might actually have to tighten monetary policy. Government has to withdraw its fiscal stimulus from the economy. And because if you don't do that, then you crowd out private sector investments, interest rates will be going higher, inflation might hit the fan, and then, situation won't be very pleasant. So those are the signals I'll be looking at.
And sort of a corollary to that for me is the concept that we're relying excessively on monetary policy. Okay, so even in Europe and in Japan, you have negative interest rates. In some sense, people are thinking, okay, then that's going to get people to borrow when they don't want to borrow. And my question is if you were to create a macroeconomic policy, where is it necessary to bring rates down to zero? Or could you have base rates at a higher level while the government is deficit spending in order to make up for the balance sheet recession?
Well, I don't think rates came down to these very low levels because central bank brought them down. The rates came down because there are not enough borrowers, even at these low rates.
Right.
And so I don't think we had much choice on the interest rates. But if the government comes in and borrow, the government can borrow at very low rates. And if you select the right projects with very low cost, those projects may become self-financing. Right? When government bond yield is 8%, it's very difficult to find good projects that earn 8%. But if it's down to 1%, if you put the bright people in one room and make them go through a brainstorming, maybe they will come up with some projects that actually self-financing. Then we will enter the best of both worlds. We will do the self-financing fiscal policy to keep the economy going, allow private sector to repair balance sheets with GDP not collapsing.
You know,
that's the kind of thinking we should have done.
One of the things I think is interesting is this, when I was talking to you about negative interest rates. And I was thinking about it in the context of the Japanese banks. What is the positive or negative implications of negative interest rates for the banking system and for the economy? Do they work in any way, shape, or form?
Well, I must say negative interest rates is just an act of desperation of those people who's clinging to this idea that monetary policy is the key tool. So you try quantitative easing, it didn't work. You try forward guidance, it didn't work. You did this, you did that. At the end, you said, oh, well, helicopter money, well, and then finally negative interest rates. But all of them failed to produce the inflation rate that these guys predicted based on their models, which suggests to me that their model is wrong. And the model is wrong because they are based on the assumption the private sector is maximizing profits and that they have clean balance sheets. But in the world we live now, we don't have clean balance sheets. And even those who just managed to regain clean balance sheets, those people are so traumatized by this experience of repairing balance sheets that they're not going to borrow money for many years to come. You know, the Americans who lived through the Great Depression never borrowed money until they died, right? Because the experience was so bad. So we're going to have a similar situation with many people who went through the 2008 experience and maybe the pandemic recession experience as well.
Right.
If they ended up borrowing money to make the ends meet, they just saved dramatically to make the ends meet. Those people are going to be very, very prudent financially going forward. So they want to have huge sum of savings for rainy days. And they will be working very hard to rebuild those savings that they exhausted during the pandemic recession, which will then keep interest rates from rising because everybody's saving. So negative interest rates, quantitative easing, all these unconventional monetary policies were developed by the people who never understood the private sector is sometimes minimizing debt. If you always operate on the assumption that private sector is maximizing profits, then at some point, if you bring rates low enough, something should supposed to happen. But if the private sector has a balance sheet problems, balance sheet problems is a life and death issue. If someone finds out that your company is actually underwater, they're not going to give you trade credits. They're not going to give you working capital. They're not going to give you anything. So unless you have cash, you're dead. And that's why they're working so hard to climb out of this balance sheet problems. And they're all doing the right things in trying to fix their financial house in order. But it's they doing the right things causing the wrong result for the macroeconomy.
Right.
And in those circumstances, you should rely on monetary policy. You have to rely on fiscal policy, government borrowing the money, because it's the lack of borrowers that's causing this problem.
As you were saying that people who believe in that it's a maximizing profit situation, they're going to go with these negative interest rates. And I know that before this, we were talking offline about your book, The Holy Grail of Macroeconomics, and we were talking about Bernankes. And he's a scholar of the Great Depression. After the Great Financial Crisis, he seems to have, understood exactly what you're talking about. Can you tell us a little bit about that epiphany on his part?
I was asked to testify in U.S. Congress with Chairman Bernankes of the Fed on the twice yearly Humphrey Hawkins testimony. And he will go in the morning, private sector sota in the afternoon, but we were all seated together. And at that time, I finished this book, Holy Grail Macroeconomics. I give this book to him. That if you have nothing better to do, please read it.
Right.
And he said, oh, I don't need that book. I read it already. And he said the parts on Japan was very useful. And I was wondering what he meant by that, because as you know, I did criticize Mr. Bernankes on numerous occasions in that book, that this is a balance sheet problem, not a lack of monetary policy problem. Then in the actual testimony, he basically told the congressman that this is no time to cut the deficit. You have to continue to put the money into the system to keep the economy going. His fiscal cliff argument.
Right.
And so even though he was a student of Milton Friedman, he did understand that once you are in this type of recession, the bottleneck is the lack of borrowers, not lack of lenders. And if the private sector cannot be persuaded to borrow, even with zero interest rates, then the government has to come in and borrow. And Chairman Bernankes understood it, and he warned the Congress about it. And that's the only reason I think U.S. did better than other economies, even though U.S. started the subprime crisis, right? U.S. was the epicenter of the crisis. But compared to other economies, U.S. came out first because the governor of the central bank, Chairman Bernankes, basically kept warning Congress not to cut the deficit too quickly. Whereas in Europe, whereas in Japan, whereas in the UK, they didn't get the message. So they went on to fiscal austerity too quickly, and the economy had double dips, but not in US. So I think he understood the message that during the balance sheet recession, you're not supposed to cut the deficit.
Well, a lot of countries seem to have understood it more now because of how serious this problem is. But when I look at across the landscape, I pinpoint Europe as probably the area where there are going to be problems going forward. And the reason I say that is because, maybe you can put your predictive hat on. Let's just say that we get to the point where we get this snapback in terms of GDP. We get back to 85, 90% of where we're supposed to be. At that point, suddenly the whole Stability and Growth Pact mentality starts to come into play. You have Italy with 160% debt to GDP. You have Greece with maybe 180, 200% debt to GDP. What would you do in that situation? Because the Europeans have a binding sort of framework there.
I'm afraid Europe is going to run into huge problems going forward. And as I also predicted that Europe will have the worst possible outcome in the balance sheet recession, in my 2003 book, The Balance Sheet Recession, the title Balance Sheet Recession, unfortunately, that prediction also came true after 2008. Because of the Maastricht Treaty limitations that you cannot have a budget deficit more than 3% of GDP, and the fact that all these countries share the same currency, these two things together made Europe totally unable to use fiscal policy. First, the legal issue, this 3% limit. Well, if you look at the data of private sector savings, once the bubble burst in 2008, the Lehman crisis, and they had a housing bubble too, all these European economies, the private sector starts saving 5%, 6%, 7%, 10% of GDP.
Right.
The private sector saving 10% of GDP. Government's only allowed to borrow 3% of GDP. What happens to the remaining 7% of GDP? That's your deflationary gap. And the private sector that saved most was Spain. Spanish private sector was saving 7-8% of GDP consistently. Government could only borrow 3%, so the economy literally collapsed. Unemployment rate shot up to 25%. So when you are in balance sheet recession, they should have just removed that restriction altogether, that 3% restriction. And that's what I was recommending in my 2003 book.
What if the Germans, they came back to you and they said, Mr. Koo, but we'll just export our way to that differential. The difference between the 3 and the 7%, we'll just have a 4% surplus in exports.
Well, that's basically what Germans did. And it was good that the Germans did it that way, because Germany was the first country that fell into balance sheet recession, year 2000. in year 2000, a lot of people have forgotten this already, but Germans went crazy over the dot-com bubble, and their market, called Neue Markt, which is German equivalent of NASDAQ, went up massively and came down spectacularly. So went up like 10 times and lost 97% of its value. 97% of its value, only 3% left. That destroyed the German household balance sheets completely. Germans stopped paying down debt, increasing savings massively after year 2001, 2002. So Germany was in balance sheet recession, but no one knew balance sheet recession in Europe at that time. But because Germany is the biggest economy in the world, in the Eurozone, and if this economy was collapsing, remember the sick man of Europe, that expression?
Oh, yeah, definitely.
ECB brought rates down to very low levels, 2%, the lowest in post-war history, trying to save the German economy. But the German economy would not respond because it's in balance sheet recession. But all other economies that were not involved in the dot-com bubble, and that's Spain, Portugal, all the other countries, they saw 2% rates, which is far below what should be appropriate. Then they went crazy.
Right.
That's how the housing bubble began in Spain. That's how housing bubble began in Ireland. They have never seen rates like 2% in their lifetime. That bubble allowed the Germans to export their way out. So you can see the German exports growing very rapidly once the rates came down to 2%. So, and export to the rest of Eurozone skyrocketed. Once the Lehman crisis happened and the whole thing came crashing down, then the euro fell as a result, which still allowed the Germans to export. And because Germany managed to recover their balance sheets while other guys were enjoying bubble, after 2008, their balance sheets already repaired by 2008. So they were kind of cool to the other guys. Says, well, we did all the hard work, you guys didn't do anything. But it's actually ECB trying to help the Germans that resulted in the housing bubble for the rest of Eurozone. So that's one thing. And the other is that Germany seems to be thinking always in the partial equilibrium, not the general equilibrium. Because if everybody has the same problem at the same time, no one can export their way out.
So they're dependent upon the UK and the US and all the debtor countries to do that.
And so just because Germans have done a good job doesn't mean everybody else can do it the same way if it's export driven. There's one other problem in the Eurozone, which not too many people want to talk about apparently, is that when balance sheet recession happens in any country, government is the only borrower left. So private sector investors ended up buying government bonds because it's the only borrower left. That brings interest rates down, and that allows the government to do the fiscal stimulus. This is what I call the natural corrective mechanism of balance sheet recession. But in the Eurozone, and that happened in Japan, it happened in the United States, happened in the UK, but in the Eurozone, it doesn't work.
No.
And why it doesn't work? Because there are 18 other government bond markets. So you don't have, if you're a Spanish saver and you're saving 7% of GDP, would that 7% of GDP go to the Spanish government bond market? No, they go to the German government bond market because they say, well, my government's running such a deficit. The other side is not running such a deficit. It's safer. Let's go over there. That's what caused the Eurozone crisis from 2001, 2010 to like 2015. It was a gruesome crisis. And to get over this problem, this capital flight between government bond markets within the Eurozone, that's something they have to deal with. Either they fix this with completely new Eurobond or something, or Corona bonds that Italians are coming up with. They need to do something about this issue, or else they really have no fiscal stimulus, fiscal policy. Put yourself in the position of Italians or Spaniards today. You have no monetary policy, you have no fiscal policy, you have so many people dying left and right, economy hit the worst since World War II, and you have no reason to give hope to the people. How would democracy survive in a situation like this? Unless Germans and the Dutch think about everything and then do something completely different. The way the Germans are acting, the way the Dutch are acting in a very Calvinist way, while everybody's stuck in this single currency situation where individually they have no fiscal policy, individually they have no monetary policy. In this pandemic world, I think is a very bad situation. And I really hope that they'll come up with something so that Euro will survive. Because otherwise, we're going to have a huge economic problem in the Eurozone, quite independent of the pandemic issue.
Right.
And that could be a drag on economic growth for everybody.
Well, you know, what I was going to say is not to be pessimistic or anything, but I don't think there's any way out there because, you know, the German Constitutional Court decision, basically, if you think about its implications, it says that you need to change not only the EU constitution, but the German Grundgesetz as well in order to do anything, even to have the ECB do quantitative easing in a non-proportional way. You need to have those changes. So to do a debt mutualization, to do Corona bonds, they would say the exact same thing. They would say Corona bonds are illegal under the German Constitution. I don't see how you get around it. I think that, you know, Europe is in an existential crisis. How do you solve that problem?
I've been proposing this idea that they should really do fiscal disunion instead of fiscal union. And what I mean by that is that in exchange for meeting this 3% deficit limit and the fiscal compact, whatever, each government say to themselves, agrees that you issue your government bond only to your own citizens. No one else can buy your government bond or hold your government bond. Only Italians can hold Italian government bonds. Only Germans can hold German government bonds. If you put that in the system so that the fiscal issue is a completely internal domestic issue of individual country, then there's no reason why Italians decided to do 7% of GDP deficit because of the pandemics. No one else will be hurt. If Italian government goes bust, only Italians are hurt. I think we need that kind of system to make the fiscal union work. Monetary union work. To make monetary union work without fiscal union is very difficult. We already know that. But we may be able to make this work if we do the monetary union and fiscal disunion to make individual governments, individual countries entirely responsible for their fiscal issues in exchange for their freedom to do whatever they want. Then, you know, other countries have no reason to complain about Greece or Italy because those bonds are only held by the Greek people or Italian people. And maybe that will be a way to get around the problem we have in the Eurozone.
That is an interesting solution. What do you think would happen to bond spreads in that scenario between, say, the Italian bonds and German bonds?
Well, I'm sure the gap could widen, but at the moment, there's a lot of Southern European money in the German government bond as well. So if they cannot go there anymore, Bund yields will probably go up a little bit also. Italian rates, Spanish rates, we don't know which way they will go. If they really operate like Japan or United States, then the rates should come down because Italians are saving a lot of money. Spaniards are private sector saving 7% of GDP even today. And if a large portion of this money ended up going to the Spanish government bond market, with no one else borrowing money on the private sector, bond yields should come down.
Right. That is interesting. Because I have heard, for instance, that Italy, the private sector balance sheets are much better than they are in, say, Denmark or the Netherlands. That,
Yes.
that would be a very beneficial thing for the private sector in Italy, and maybe that could spur some growth because they wouldn't have a recession. They're not in a balance sheet recession from the private sector.
Right. The balance is already repaired.
Well, anyway, it's been a great conversation talking to you. I hate to end it here because we could talk forever. I really appreciate your taking the time to talk to us today.
Oh, thank you very much for this opportunity.
If you're ready to go beyond the interview, make sure you visit realvision.com, where you can try Real Vision Plus for 30 days for just $1. We'll see you next time right here on Real Vision.